So I think one of the things that caught my attention early on was Beacon Capital has something that I don't see used in the market, although it makes tremendous sense. And that's a stop loss. So when then certain factors, certain things happen, that a sale occurs, there's a transition in the portfolio, so that because I'll let you speak to the probabilities and what's been selected and so forth. But that was one of the things that caught my eye is how can we protect our capital, our investments, when the markets all of a sudden get very choppy and go down by 10%, 15%. What about 37% back in 2007? So speak to that, if you would, please. What is the stop loss that Beacon incorporates?
So we implement a stop loss strategy. And what that does is it allows us to participate in the markets until they reach a market high. And when our benchmark drops 10% from that high, we exit the market and we receive yield in fixed income investments. Now, the obvious question is, well, that's great. You get out at 10%. Why is that important? Chris in his studies found that when the benchmark drops 10% for us, 1 out of 2 times it drops 20% or more. So that means 1 out of 2 times we're on the right side of the trade. 1 of the 2 times we need to get back in the market again. However, 1 out of 4 times the market drops 40% or more. And that's really where we make our gains as a portfolio manager. When the markets are down 40% and we're able to re-enter the markets at a lower point, that's where we really help out our clients. So our first portfolio is a stop loss strategy.
I remember seeing that also caught my attention very quickly early on when I saw that in 2008, when the overall market, the S&P index, was down by over 37%. So I thought, well, how did Beacon do that year? And if I recall, it was about 8 or 9% positive return, and yet minus 37% in the equity markets in 2008.
So here's a graphic that shows how our stop loss strategy works. It shows we invest in all 11 sectors of the economy. As the market rises, we continue to note that. When it finally reaches a high, we mark it, and should it drop 10% from that high, we exit the equity ecosphere and go into a yield-bearing instrument, U.S. Treasuries. But the logical question is, well, when do you get back in? Same thing. We use a mathematically reasonable process for getting back in. We're not guessing. It's all based on mathematics. And what this chart shows, the bottom left-hand corner here, is measuring the point from which we get out of the market. At that point, the markets have come down 10%. We need a 15% recovery to get back in the market. However, what often happens is another low is established. So let's say an example where the market drops and then 60 days later, it hits a new low. We come back to this chart and we say, okay, a new low has been established. It's 60 days. We're now going to need a 19% recovery from the new established low. You think of a year like 2000 to 2002, that 2-year period continued to reach low after low after low until ultimately, after 360 days, our final buyback is 25% to get back into the market from the all-time low.
So I think, Lou, that really gets to your point that you were saying, is that when the markets drop, when that basket of and we haven't gotten there yet, but I was also surprised to find out that there are only, wait for it, 11 sectors that make up the U.S. economy. That's it. There's not 27. There's not, not 50. No, there are 11. And of those 11, 2 of them are just for consumers, consumer durables and consumer spendable. So not that many sectors to have to track. And that's the beauty of the Beacon platform, is it's so low cost because for the most part, we're using Vanguard sector funds to be able to invest, get the breadth of the whole U.S. economy at a very, very low cost. But again, it was surprising to me in some of these years when we've had tremendous market volatility, how well Beacon has done in those years. So it gets to your point. You're not going to guess right every time. And as I understand it, I think there have been 14 recessions since World War II, something like that. So there was a great deal of data for Chris to study in coming up with these algorithms that, while not perfect, will keep us more often than not on the right side of the math.